Hello and welcome to the Global Forecast from the Economist Intelligence Unit. I'm Tony McMahon, and as ever I'm joined by Robin Bew. Robin, do you think that the Eurozone now faces the realistic prospect of a breakup?
I think it is realistic. It's not our central forecast, but we do attach a 40% probability now to the idea that the Eurozone will break apart, and that's an extraordinarily high probability to put on an event which would have such a dramatic impact on the global economy. So it's something that we are very worried about and very focused on at the moment.
I mean, what sort of global impact would the breakup of the Eurozone actually have?
Well, I think we'd be looking at a financial crisis as well as an economic crisis, which would be at least of the magnitude of what we saw happening in 2008 and probably worse. And if you look at what would happen in terms of finances, a lot of the financial sector in Europe and indeed even outside of Europe would see very, very significant balance sheet hits. Lots and lots of banks within the Eurozone have an awful lot of sovereign debt on their balance sheet. Some of that sovereign debt for the countries that dropped out of the Eurozone will become worth much, much less than it is today and much, much less than it's marked down to in their balance sheets at the moment. But not only that, but you'd see a lot of private sector defaults in the countries that fell out of the Eurozone too. And of course, all of that will be balance sheet hits on European banks primarily. But of course, European banks themselves have borrowed very heavily from banks in the rest of the world through the interbank market, through the wholesale market. So we have a lot of American banks which are quite exposed to the Eurozone financial system as a whole, so they would be hit too. So you'd see the kind of balance sheet shakeout in the banking sector that we saw in 2008 when we had the Lehman's crisis. But of course, over and above that, you would see the macroeconomic impact of a tremendous real shock to the Eurozone. So you'd see the countries that fell out would have much, much higher inflation. They'd have to worry about how to set monetary policy in that kind of environment. The countries that stayed in would have a much stronger exchange rate. They'd see their export growth start to be choked off. So the economic impact would be very stark. And that, of course, is the reason why our main forecast is it won't happen. The economic impact is so great that we think that governments ultimately will do whatever it takes to prevent it from happening. The only trouble is that we think they have a limited amount of time to fix the problems that we see in Europe, and so far they're not moving very quickly.
And I mean, does the problems of the Eurozone, do you think, contribute to the risk of a double dip recession scenario?
Absolutely. I mean, I think we see two things going on. Firstly, there is this danger that the Eurozone falls apart if Europe is not able to coalesce around the policies which would enable it to hold together, and we can talk about what those might be. So that's one danger. If that happens, clearly lots of recessions in Europe, and we believe recessions elsewhere in the world. But of course, there is another risk, because even without the Eurozone running into that kind of seismic problem, we still see all this balance sheet adjustment playing out around the world. So if you look to America, I guess that's the most interesting country right now. Tremendous balance sheet stress in the personal sector. So we see households, lots of them underwater on their mortgages, lots of mortgage delinquencies, people still trying to save. And as a result, the economy only creeping ahead very slowly, and a real danger that they could drop into a recession, rather like what we saw happening in Japan in the 1990s, that the economy, people are so focused on saving, they really forget how to spend, and they don't really want to spend, and the economy does very badly through that direction as well. So I think two things to worry about. One is that America just stumbles into another recession, and one, of course, much more serious issue, that the Eurozone starts to fall apart and that the whole world is damaged greatly by that.
And do you see a change then in the way that the US government and European governments are going to respond policy-wise towards this scenario going forward?
Well, I think if you look at the Eurozone first of all, right now there's a real tussle going on between the economists, who recognise now what needs to happen, which is that the Eurozone collectively doesn't look in bad shape in terms of fiscal policy. It's just, of course, when you look at the individual nation states, we have lots of states with problems. That's the reason that everybody is talking about the idea of pooling fiscal sovereignty, having some kind of Eurobond. The idea is somehow fiscal policy could be kind of unified across the Eurozone, they'd all be all right. Now, of course, the difficulty with that is it does essentially mean the stronger members have to carry the can for the problems we're seeing happening in the weaker members, and politically that's not a very appealing story at the moment. Now, of course, the Eurozone falling to bits is also not a very appealing story, but most politicians in Europe don't want to talk about that. So if you look to what's happening in Germany, Angela Merkel is running a story at the moment which says we ought to bail out Greece for solidarity reasons, and of course, German population isn't very keen on that. She's certainly not saying we ought to bail out Greece because if we don't, the German economy is going to be absolutely hammered. But actually, that's the truth. That's the reason that bailing out Greece and these other countries looks appealing. So we need to see more policy action there, and that means that politicians need to get over this fear of their own electorates. And I guess the reason that we attach this 40% probability to break up is that politicians have to be pretty bold to persuade the populations to come with them on pooling fiscal sovereignty in the Eurozone. But unfortunately, as more and more countries are picked at by the financial markets, the stakes get higher and higher. Politicians will either have to make that leap and explain to the electorate the dangers of doing nothing, or we will see countries being pushed into a situation where they're going to want to leave. If you look to America, I think actually politicians there at the moment, the story's not that great. The debt deal that we saw put in place just about a month ago or so, which had the debt ceiling raised, also meant that we were going to see quite a sharp fiscal tightening happening next year. And we don't really need a sharp fiscal tightening in America right now. The economy is pretty weak, and Barack Obama is trying to put forward some proposals now which will mitigate that to some extent by getting a bit more stimulus through next year instead. Clearly, Congress is not playing ball, and Republicans certainly not very keen on any more stimulus. That kind of suggests, particularly because we're getting closer and closer to the next presidential election, that you could see a bit of an impasse, and America may inflict something of an own goal, as we would say in Europe, or self-inflicted wound, by tightening fiscal policy into the face of a very weak recovery anyway, and tip the economy into recession. So I'd say politicians need to get serious, but right now we're not seeing much seriousness.
And there are some analysts who've been suggesting that a dose of inflation may not be such a bad thing. I mean, it's the unthinkable, but, you know, we've got people like Ken Rogoff who've been suggesting this quite openly.
It's not, I don't actually think it's that unthinkable. When you see balance sheet stresses, and ultimately, of course, Europe and America, very different situations because the European single currency makes the problem so much harder to manage there. But essentially, in both countries, both markets, what we see is a lot of balance sheet stress. We see we see an enormous amount of debt supported by a set of assets which are not worth anything like as much as everybody thought. Now, one way to deal with that is to pay off a debt, and that's what we're seeing happening. And in America, that's pushing us quite close to a recession. But of course, the other way to deal with it is to try and raise the value of the assets, and you do that through inflation. I mean, interestingly, central banks around the world have been following the policies which would normally be expected to boost inflation. They've been printing money. Interest rates are extraordinarily low. Hasn't actually been effective, but it's a pretty time-honoured way of dealing with these balance sheet problems. In fact, it's all very unusual to see countries run into the kind of debt problems that we see today and find that solution, but at least part of the solution isn't higher inflation. The worry, actually, I think, for central banks at the moment is that while they're pulling all these levers, and you are seeing inflation higher than we would normally expect, that's largely coming from commodity prices. And actually, the nervousness in the part of central banks is that their ability through monetary policy to influence the course of demand in their economies is actually much more limited than it might seem at first blush. We have high inflation in Europe, and we have high inflation in the US, particularly if you look to the UK, very high inflation here. But yet central banks, they're dubious of their ability to influence things. And of course, if you look to Japan, they pursued a policy of printing money for the best part of a decade, but it didn't make any difference to their inflation story.
I'd be very remiss not to mention events in Libya and the wider Middle East. And I just wonder, I mean, what do you think are going to be the wider economic consequences of those huge, momentous political events that we're seeing unfold at the moment?
Well, I think it's I guess it's quite early to start to say specifically in the case of Libya. I mean, our view there is that you will see some kind of election and there will be a move away from the kind of autocracy that we've seen up to now towards something that's a bit more democratic. Actually, across the whole of the countries which have been affected by this, so if you look to Libya but also Egypt and Tunisia, I know that some analysts are hoping that we'll see a kind of outburst of really strong democratic trends and a real opening up of the business environment. Our view is a little bit more cautious than that. We think that we've described what we expect to get as a meagre harvest of democracy and improvement in the business environment. So I think things will clearly get better. And in the case of a country like Libya, which have been kind of cut off from sort of international economic influences for a little bit, I think you will see quite a bit of foreign investor interest, and clearly as an oil state that will probably be magnified relative to perhaps what you might see in Tunisia. But I think it would probably be wrong to assume that you're going to see some kind of economic renaissance there, that things will get a bit better, potentially a bit better than they were before, but certainly in terms of the socio-political settlement that comes out, I think when you look back in 10 years' time, probably people will be a little bit disappointed that their highest ideals were perhaps somewhat dashed. So things were better than they were before, but not as good as perhaps we would like.
Well, thanks, Robin, for those insights. And thank you for watching. If you'd like to know more about the sort of things that Robin's been talking about today, then go to the Economist Intelligence Unit website at the address that's appearing on the screen now. Thank you for watching again, and look forward to meeting you again next month.